Interest rates ready to tumble.
That's because Michelle Bullock is nervous. In cutting rates by 0.25 percentage points, the Reserve Bank was warned geopolitical uncertainties remain pronounced. Michelle's worried about Australia's long-term economic outlook going as far as raising the spectre of global recession.
Ooh, that's bad.
And we're all ecstatic about tomorrow's impending doom because we get to save a few bucks on our mortgage today.
That's good.
Investors were so excited about the prospect of a contracting economy, mass layoffs and rising debt that they drove the ASX to a fresh 3-month high. Is it just me, or is it weird that we all start relaxing just when reserve banks start panicking?
That doesn't make sense.
Everyone's loving Michelle.
So much more than what's his name.
I'm certainly sorry if people listen to what we'd said.
Tuesday's cut means someone with a $500,000 mortgage will save $960 a year. Punters now got to make a call about whether they drop their minimum monthly payment so they have some more walking around money. And by walking around, I mean walking into Dan Murphy's, where for $960 you can buy 274 bottles of what promises to be the world's most shit wine. If, however, you maintain your current payment schedule, that means paying close to an extra $1,000 off your mortgage a year, then over the course of the 25-year life of your loan, assuming it's around 5.5%, you will save $25,600 in interest and be debt-free 1 year and 3 months earlier.
A sensible option.
It's called deferred gratification, resisting the temptation of an immediate reward in favour of a more valuable prize later. It's what grown-ups are meant to do.
Boring.
Getting pissed or saving interest on your mortgage aren't the only options for that $960 a year. What about superannuation?
Boring.
Hear me out. Let's say you're 40 years old.
This is not a good look for me!
At that age, the average super balance for men is just shy of $140,000 and it's a bit over $107,000 for women. If you're on a high growth option, the annualised returns of around 10% will mean that in 25 years your nest egg will be $1.5 million for men and $1.15 million for women. Put that $960 a year Michelle just gave you into your super for the same period, and that $25,000 in extra contributions will generate an extra $100,000 into your nest egg when you retire. If you are a real grown-up, you would have resisted the urge to reduce your payments not just after this latest cut, but also the one last month. That would put a person owing $500,000 $1,920 a year ahead. Putting that towards your mortgage would mean a shade over $48,000 in interest saved. Putting it into super would mean an extra $188,000 in your nest egg.
Wow. What will you do?
Dan Murphy's.
Seriously, super or mortgage?
In raw terms, it looks like super, but I say mortgage. The most effective financial advice you will ever get is also the simplest and most boring. Pay off your home as fast as you can and then salary sacrifice flat out into superannuation. Michelle just made that a little easier for all of us.
Thank you.
No, thank you. I'm Ben Harvey.